All right, today we're going to pull back the curtain on one of the most popular tools you'll find in any trader's toolkit, Bollinger Bands. Let's dive right in.
I mean, seriously, what if a chart could just tell you the market's mood? Like, is it sleepy and quiet, or is it wide awake and going crazy? Well, that is the exact problem Bollinger Bands were created to solve. They give us this amazing visual framework for understanding both a security's price and its volatility.
So here's what we're going to cover. First up, we'll get to know the bands themselves and what they're made of. Then, we'll dig into how they help us actually read market volatility. After that, we'll walk through a really common trading strategy called the squeeze and breakout. And finally, and this is super important, we'll talk about their limitations because, no tool is a magic bullet.
Okay, so first things first, what in the world are Bollinger Bands? To really get it, I think it helps to go back to the very beginning and meet the person who came up with them. So this all got started back in the early 1980s with a financial analyst named John Bollinger. See, he was looking for a more dynamic, more adaptive way to look at the markets. And the tool he came up with? It became so essential that today, you'll find it as a standard feature on pretty much every single trading platform out there.
The entire system is basically built around three simple lines, and at the heart of it all is the middle band. You can think of this line as the center of gravity for the price. It's usually just a 20-day simple moving average, and it gives us a nice clean baseline for the medium-term trend. All right, next up we have the upper band. Now, to get this line, we use a statistical concept called standard deviation, which, don't worry, is just a fancy way of measuring how spread out the prices are from the average. The upper band is simply drawn two of these standard deviations above that middle band, and it acts as a sort of dynamic price ceiling. And you guessed it, to complete the channel, we've got the lower band. This one is plotted two standard deviations below the middle band, so it acts as a kind of relative price floor. Put them all together, and these three lines create this awesome flowing channel that wraps right around the price. So, why is that two standard deviations number so important? Well, here's the cool part. Statistically speaking, it means these bands are designed to contain about 95% of all the price action. Think about that. So whenever the price moves outside of this channel, it's a pretty big deal. It's an event that really makes traders sit up and pay attention.
Okay, so we've got the components down, but why do traders even use them? What's the main goal here? Well, it's all about one thing: decoding market volatility. It's about taking this invisible force and making it totally visible right there on your chart.
And this slide just illustrates the concept perfectly. When the bands get narrow and squeezed together, it means volatility is super low. You can picture it like a calm, slow-moving river. But then, when they start to widen and spread apart, that's when volatility is high. That calm river is now a raging torrent. The bands literally expand and contract right along with the market's energy.
And this quote from John Bollinger himself really hits the nail on the head. Periods of low volatility are often followed by periods of high volatility. It's such a key insight. The market moves in cycles, right? So a quiet, calm market is often just coiling up, building energy for its next big move. That quiet period, that's a signal all by itself.
Which naturally brings us to one of the most popular strategies that traders use with this tool, spotting something called the squeeze, and then trading the breakout that follows. So the squeeze is exactly that period of low volatility we were just talking about. You can literally see it on the chart, when the upper and lower bands start moving closer and closer together, almost, squeezing the price. Traders get really interested when they see this pattern, because it's often a clue that a big price move, an explosion really, could be just around the corner.
So, how does the strategy actually play out? Well, it's a pretty straightforward three-step process. First, you spot the squeeze, when the bands get nice and narrow. Step 2, you patiently wait for the breakout. That's when the price makes a decisive move and closes outside the bands. And third, you confirm the new trend. A break above the upper band, that's typically seen as bullish. A break below the lower band, that's bearish.
And here's a super handy little cheat sheet to keep in mind. If the price touches the upper band, the asset might be getting a little overbought. If it hits the lower band, it could be oversold. When the bands get narrow, you know what that is. That's the squeeze, low volatility. And when they get wide, volatility is back in town. It's just a simple, visual guide to the market's rhythm.
All right, let's get to what might be the most important part of this whole explainer. Bollinger Bands are an incredible tool. They really are. But, and this is a big but, they are not a crystal ball. You absolutely have to understand their limitations.
The number one thing you have to burn into your brain is this: Bollinger Bands are a lagging indicator. What does that mean? It means they are calculated using past price data, so they can only react to what the market has already done. They do not, I repeat, do not predict what's going to happen next.
And that fact leads to some really key limitations you have to be aware of. For one, they can give you false signals, or head fakes. For example, in a really strong trend, the price can just walk the band. It'll hug that upper or lower line for a long time without ever reversing. Also, the standard settings might not be the best fit for every single asset. And that's exactly why smart traders never use Bollinger Bands in isolation. They always use them with other tools, like an RSI or a MACD, to get confirmation before making a move.
You see, Bollinger Bands don't really give you the answers. What they do is help you ask much better questions. They take that invisible force of volatility and they make it visible right on your screen. So the real question isn't, do they work? The real question is this: now that you can see volatility, what are you going to do with it?